So here we are at debt investments. So before we get into the debt investments, I just want to do a little bit more on what are debt investments. And I'd like you to think back to Chapter 10, long ago and far away, long-term liabilities, where we issued bonds payable. We paid interest to our bondholders. We redeemed bonds payable. We bought them back off the market. Now, if you think about the market, in Appendix C, we're on the other side of the market. We are buying the bonds that that other company issued, or that other entity issued. We're going to be receiving interest revenue. So we're going to be recording an asset. Investments are an asset. So we're in the asset section of the balance sheet now. We're investing in the debt of other companies, essentially. But we receive interest revenue, and we'll be recognizing gains and losses on the transactions when we sell them. Okay, so now just a little bit more on who issues bonds payable. We can have corporations who, I went through a little of the process of how they have to go through the Securities and Exchange Commission. So corporations may issue bonds for long-term projects, but also the U.S. Treasury issues, T-bonds. You can have municipal bonds. The city of Boston could issue bonds, for a big project they were doing. The Commonwealth of Massachusetts issues bonds. Some of them, they issued some green bonds at one point to finance the building of infrastructure for offshore wind farms. So they were doing a lot of building projects in New Bedford for that, financed by bonds. And so then other government agencies can also issue bonds, like the MBTA could hopefully issue some bonds to upgrade the system. Anyway, so these are your sort of who is actually issuing the bonds. Usually they will pay interest twice a year, and then they also have a maturity date. We don't necessarily, when we're buying them, have to hold them to that maturity date. Okay, so let's move to the trading. If we've bought these debt investments and we're planning to sell them in the near term, these we would classify as trading securities. And so we're going to have, we'll do the accounting for them first. And I'll use this example here. So say we buy $1,000 City of Miami bonds that pay 6%, and we pay $5,000. So let's just start here, 1-1. We would have our debt investments, and presumably we would pay some cash. And since we're ignoring transaction fees, it'll just be $5,000. Then when we pay the interest, this is we're going to be receiving some cash. We're going to be booking interest revenue. And then figuring the amount is just the way we did it before. We're just going to go the 5,000 bond times 6%. So that would be $300 annually, but because there's two payments, we'll receive $150 each time. Okay, then say we decide to sell a couple of the bonds. So on 7-1, after we've received the interest, we decide to sell some. So we're going to get some cash. We're going to be taking the debt investments off our books since we're selling them. Now we're only selling, it says we're selling 2 of these 5 bonds. Okay, so we got $1,500, so we know that. But then we have to figure out, well, what was the cost of these bonds we sold? So here we go, we sold 2/5 times the $5,000 cost. So the cost of the bonds we sold would be $2,000. The math won't always be that easy. Okay, so debt investments come off the books for $2,000. And if we look at this, oh, this is a little bit sad. It looks like we have a loss on the sale of investments. Okay, so we get a loss on the sale of investments of 500. Wah, wah, wah. Oh well. All right, so that's where we are there. So now we come to the year end. And because they are trading investments, these need to be reported on our books at their fair value, or on our financial statements at their fair value. Okay, so this says the current market value for the bonds is $3,200. Okay, so we had 5,000 to start. We sold 2,000. So the cost left on our books right now, let me go here a little bit. The cost of the bonds we have left is 3,000, and the market is 3,200. Now we're supposed to be using this amount on our financial statements. So at 12/31, we make an adjusting entry to get there. Okay, and what we're going to do, we haven't sold these securities, but we're going to adjust the fair value. So the fair value has gone up. So we're going to be using an account called, let's see, where are we here? We're going to go fair value adjustment trading. And we do have to specify that it's trading, not available for sale. Uh-oh. Oh, I haven't lined things up well here. And so that would be for 200. Okay, I'm just going to have to cram that right in here. And then we have an unrealized gain. Because it's unrealized, because we haven't sold it. And we have to specify that this is going to be income, because on trading securities, that unrealized gain gets reported on the income statement. Okay, so that's our debt investments trading. Debt investments held to maturity, we don't really do the accounting for them, but we'll just sort of talk about them for a second here. The debt investments held to maturity are ones that we plan to hold until they come due. And they are, management has to have the ability and the intention to hold them until they come due. The book simplifies this, saying that they're just on the books at cost. Please take a look at the note on the notes that go with this, that they're actually reported at their amortized cost. Just, I don't want you to go on to other accounting courses and think it's just at their cost. We do not do the accounting for this category, but we have to learn about it, because the debt investments trading are the ones we're going to sell in the near term, very soon. Held to maturity, we're going to hold until they, come due. And available for sale are basically anything that's not classified as one of these two. Okay, so it tends to be a big category for a lot of the companies. Available for sale, we're basically going to sell these sometime. So using the same example here, except now they would be available for sale securities. The journal entry to buy them would be the same. The journal entry to recognize the income would be the same. The income to sell them would be the same. But because they're available for sale, the journal entry to adjust them to fair value at year end would be a little bit different. It would be fair value adjustment available for sale, and I haven't got room to write that out. And it would be unrealized gain equity. And why equity? Because these are reported not on the income statement, these unrealized gains and losses, but on the balance sheet in the stockholders' equity section. If you think back to, we would get a total of paid-in capital and retained earnings, and then we would deduct treasury stock. That is where we would also record any unrealized gains or losses on available for sale securities. And so that's why it would be unrealized gain equity, because it's in the stockholders' equity section. Okay, so let's just take a minute to think about why all these categories and accounts, where the purpose of your financial statements is to provide useful information, and it should be based on the economic reality of what's going on. So held to maturity, there's no intention to sell those until they come due. It could be 5 or 10 years out, and who knows what the market value would be then. So the market value of those is not relevant. So there's no unrealized gains or losses reported on these. They're just on the books at their amortized cost. Okay, the trading classification, okay, we're up to the trading. This tells financial statement users that we're about to sell these investments in the near term, maybe in the next 3 months. And so current changes in the market value are very important, and the current and the fair value of those stocks is very important because the transaction is going to happen very soon. So we report the unrealized gain for our trading securities on the current income statement, even though we haven't sold the stocks yet, or the debt investments yet. Okay, the available for sale is basically anything else. We might sell them soon, we might sell them further out, but it's not going to happen, not necessarily going to happen right away. So if we reported those unrealized gains on the income statement, unrealized gains or losses, it could add to what's called the volatility of earnings. In other words, the stock market goes up and down and up and down, and it would be kind of, it could just add to the sort of an erratic earnings curve if we reported all of these on the income statement, which is why they bypass the income statement and they get reported on the balance sheet in the stockholders' equity section.